From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, November 16th. Here are the top market stories we're following for you at this hour. Walmart warns Macy's makes magic. The big box retailer says the consumer's weaker than 3 months ago, while Macy's profit beats. And Xi woos Wall Street. Now, there were small wins for President Xi and President Biden at the APEC summit. Now, the real prize is Wall Street. We see that investors are changing their view on China. And hedge fund layoffs. Schoenfeld reportedly cutting 15% of its workforce after ditching talks with Millennium. We're going to get the latest. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. I have to be honest, what I'm also watching is what's happening with the oil price. It's down almost 3.5%. It's been a big slide. I do feel like it's telling us something, but what it's telling us is more disinflationary rather than growth. The market seems to be taking that in a good way, Guy.
Well, initially, it's a relief, you could argue, and you could argue it's disinflationary. That means that Fed cuts become even more likely. That seems to be a good thing. You can kind of draw that line, maybe. But yeah, I think it's an interesting signal. Also, I think the oil market is definitely kind of having another go at OPEC. We're getting down to some interesting levels right now. Are we going to see intervention again? The market feels like it wants to challenge OPEC once again. I don't know. What do you think? Is OPEC going to respond? Will OPEC have to respond?
Oh, yeah. I mean, they're definitely going to continue their cuts. I mean, they made it very clear, specs, don't push us at the end of the day. Yep. So they're definitely going after that. If it does tell us a macro signal, is it about Europe? Is it about China? Is it about the U.S. or none of the above?
I think it's probably all of the above. So I think today's really interesting. You look at what the retailers are telling us. Top line is slowing down, but we can manage our inventory, therefore profitability looks good. But how long can they manage that top line slowdown before it starts rippling through into the bottom line? They've kind of supported, look at Macy's, supported the inventory story. So that's kind of protecting them at the moment. You take a look at what's happening with the claims numbers today, tick higher. That's certainly something to pay attention to as well. The China story, I thought, Alex, is absolutely fascinating. Did anything really come out of yesterday other than maybe we can talk to each other if we've got a military problem? It didn't feel like the major issues were really addressed.
Right, and I just go back to that fund manager survey, and I know we'll talk about this throughout the 2 hours, is that the second most crowded trade is short China equities, and that's actually been building over the last 3 months. Does that change at some point if pessimism is so strong there?
I would have thought, you had some negative data out of the housing market of China today, but I would have thought if the market saw yesterday as a turning point, we would have seen Chinese equities rally. That didn't happen. Look at what Alibaba's done. It's pulled its cloud. It's completely ditched its cloud listing. The supermarket business is kind of going to be put on pause as well, the listing of that. The message coming out of the Chinese stock market today is not a positive one. So that takes us to our question of the day. After we've seen this big summit, after all of the sound of fury, is China more investable after this summit? Joining us to discuss, Bloomberg's Enda Curran and Anne-Marie Hordern, who was in San Francisco. Anne-Marie, I'm going to start with you. There was none of the big issues, it seems, tackled yesterday from a market point of view. We didn't see anything on chip technology restrictions, investment restrictions. We didn't see anything on the South China Sea and the tensions there. Did anything change yesterday from Wall Street's perspective, despite all of the big names showing up for the dinner?
Well, Guy, I'd answer this in two parts. One, all these small deliverables, whether it be the fentanyl agreement, potentially Boeing, what is happening when it comes to climate change and new renewable progress both these countries want to see. And then, of course, some of the bigger priority for the administration is to get the military-to-military communications back on track. All of that was done, Guy, leading up to this visit. The fact of the matter is the deliverable was these two men of the biggest economy meeting. So to your point, Xi Jinping came into this knowing there wasn't going to be a big breakthrough when it comes to export controls or tariffs. But with that said, the second point is Xi Jinping struck a very dovish tone when he sat down with those CEOs yesterday. He said he does not want to unseat the United States. He says China does not want to engage in a hot or cold war. He is trying to make sure that he is setting a path forward for more foreign direct investment, which we have seen take a hit recently, as well as for more executives to come to China and to invest in China. Over the summer, Gina Raimondo said companies tell her time and time again that China is uninvestable. And she said she said this to Chinese leaders. And Xi Jinping really struck a dovish tone. I think he is trying to assuage those concerns.
Okay, so China direct investment has taken a humongous hit. I mean, that chart is pretty stark. And did anything over the last 24 hours help change that decline?
Well, it was a very conciliatory message, like Anna-Marie just said. But there are a couple of things going on with the China investment story. On the portfolio side, money is pouring out. It's on track to leave China at a record pace this year. That's because of the yield differential, for example. So that speech last night in San Francisco isn't going to change the money flowing into China's stocks and bond market. And then on the FDI side of things, that's where there's a lot of negative sentiment, because even though the Chinese leadership preaches that they're open for business, there has been very strict regulatory crackdowns on core industries. We've had, of course, raids on foreign business in China this year. All of that erodes confidence. Now, of course, this message is coming from the top, but I would have thought, given the sentiment indicators that have come out of the chambers of commerce in China over the past year or two, I think there will be a wait and hold approach, I think, in foreign business to see just where this tone and where this relationship does go from here.
And as you say, series of small victories, but they're only small. So what needs to change, big picture, for the narrative to shift? We've got the charts up at the moment showing the foreign direct investment story, as you say, absolutely plunging. What needs to change going forward? Is it on the Chinese side? Is it a domestic story? Can anything change in the relationship with the United States to alter that investment story?
Well, so for investment on the Chinese side, there would have to be, say, an end to what looks like kind of arbitrary and random raids by the security services and foreign companies. That's obviously a source of concern for people doing business there. There would, of course, also have to be more steps towards bringing down market access, bringing down the kind of barriers that business complain about in China all the time. We know, of course, China is pursuing its own strategy of national champions down in the high-tech space, for example. There are key areas where China could take steps to alleviate foreign business. But, of course, we're not there yet, and last night's speech doesn't change that, I think.
So to that point, Anne-Marie, if it's more of a wait-and-see, wait-and-hold perspective when it comes to, say, a company or a foreign direct investment versus not worse, is that kind of what they achieved over the last 24 hours?
Yeah, you know, Kurt Tong, who's a former diplomat in Asia, said this really wasn't a meeting about can it get better. It was a meeting about making sure this relationship doesn't deteriorate further. So it's about maintaining some level of communication and progress, putting a little bit of a floor on it. We should also note that it comes at a time when this administration is also, Joe Biden is running to be the president there's an election in November of 2024. So the rhetoric is going to get very hot. So it was like the last moment these two men could really meet before the temperature starts to rise again in terms of the rhetoric, because you've already seen President Biden pushed by the Republican Party saying he is not tough enough when it comes to China, even though this administration has kept the tariffs in place, has enacted more export controls on China. The rhetoric's going to get hotter. So it really is about putting a floor on this relationship and potentially trying to get back to what Biden calls a little bit more of a normal cadence when it comes to communication.
And just in terms of what else is happening, it's not just the politics. It's not just what is happening between the United States and China. It is also the data that are grim at the moment. We saw the housing data. I think it's the worst number ever we've seen overnight, or the worst number certainly for a long time. In terms of the underlying picture for the Chinese economy, the Siemens CEO today saying in Europe that he thinks we're getting towards the bottom. We're bottoming out right now. Is that what the data tell us?
So there is a view that China's weak economy is one of the reasons that Xi Jinping came to the table the way he did, actually, with that plea to business, because he recognises they do need foreign capital now to try and help turn things around. But to your point, Guy, I think the property sector, doesn't appear like it's fully bottomed yet when you look at the latest data overnight, and that certainly has come as a surprise to people. The property slowdown remains one of the biggest threats for the global economy next year. However, look at what's going on the consumer side. That is proving to be more stronger than expected, and we're starting to see a turn now with the authorities in Beijing talking about putting more money into the economy. Look what happened to iron ore price this week in response to that. So the real estate slump is there, but the consumer is holding up, and now there are signs that the stimulus story will turn. So it might be a better 2024 for China's economy than 2023 was.
Yep, which sounds very similar to Siemens, as we were talking about. Just we're going to cover their shorts if you're an investor and you're shorting Chinese equities. All right, guys, thanks a lot. Great setup for the next couple hours. Enda Curran and Anne-Marie Hordern. And in the next hour, Anne-Marie will be back again with her interview with Rahm Emanuel, the U.S. ambassador to Japan. Coming up, more insights into the question of the day: is China more investable after the summit? Ankur Crawford is Executive Vice President and Portfolio Manager at Alger. She joins us next. This is Bloomberg.
There has been a little bit of bite that we have seen on the consumer.
Seeing those cracks in the consumer show up more readily.
When we look at retail sales from a real perspective, adjusted for inflation, volumes are still declining.
When we look at the credit card delinquencies numbers, the auto delinquencies numbers, those are picking up ever so slightly.
Retailers certainly need higher volume to kind of get to the numbers that they want.
If we look back at Q3 earnings guidance from a number of companies,
The consumer is tapped.
Their wallet is very much under pressure.
a key trend that came through was the fact that consumers are under increasing pressure.
The American consumer does have the propensity to spend.
Continues to spend.
When consumers have jobs, they will continue to spend.
The labor market is the catalyst for it.
Will this holiday season be a source of upside surprise or downside surprise when it comes to consumer spending?
The real question is are we going to have a slowdown?
It's all about the consumer.
All about the consumer. All right, those were some Bloomberg TV guests earlier commenting on the strength of the consumer. On the one hand, you got oil down 4%, so maybe that's not a terrible thing. But it is a broader question, though. When we take a look at the broader economy, which is China. Knowing what the growth trajectory will be is quite important, and that kind of is the question of the day. Is China more investable after the summit over the last 24 hours? Here with her take is Ankur Crawford, Executive Vice President and Portfolio Manager of Alger. Okay, so what do you think? There's a lot of shorts out there, shorting Chinese equities. Did anything change for you, investable-wise, in China in the last 24 hours?
I think thawing is good,
okay,
but it doesn't give you the green light. And in part because there are a few different issues that are keeping investors out of China. You know, the big issues have been AI and the technology transfer from the US to China. That wasn't on the table at this discussion. You know, the ability for the Chinese government to have a very heavy hand on investable Chinese companies. So they run it for the people versus for the benefit of the shareholders. That will never be on the table. And Taiwan, which is kind of the most obvious one where, you know, we are never going to agree with them on their take on Taiwan. So, you know, thawing is good. It's a removal of a negative, I suppose, of a super negative, but still not clear you want to jump in and invest in China.
Ankur, one of the kind of things that we are, though, seeing is maybe a bottoming out of the data. The Siemens CEO was talking about this a little earlier in an interview with us. If the economic trajectory in China starts to improve, does that change whether or not China is investable or not? You just laid out a whole load of factors there that I wonder whether they sort of supersede that economic improvement. And even if the economy does improve, people still won't put money to work.
I think that's a possibility. And in part, I mean, look, the biggest sticking factor that for us has been the lack of control that shareholders will have on these Chinese companies. China will have a heavy hand. I mean, they came in, 2 years ago, 3 years ago, Jack Ma disappears, and the same thing is happening with other large tech CEOs. So, that's from a governance perspective, it's just hard for U.S. investors to invest there.
When you're looking at a company level, are you worried about companies that have a lot of share to China, like an Apple, like we've seen when it happens in the difficulties of Huawei's phone gaining popularity there, et cetera? Like, how does that factor into your thinking?
It absolutely factors into all our thinking. China is a big consumer of iPhones, and they're an end market, whether it's for industrials or materials, the EV, Tesla.
the EV market. So, you know, but that is a slightly different ball of wax, and in part because that's the end market and the health of the consumer and the growth and the stimulus that the Chinese government is allowing into their economy, which is a little bit different than the control aspect of what China is doing to the companies that are Chinese.
Okay, let's talk a little bit about what else is going on around the world today. Oil prices are coming down pretty sharply. We're seeing the bond market responding to that. You've got the retailers telling us that the top line is slowing down, i.e. the consumer's spending a little bit less. Now, they're well positioned for this, and therefore it's not affecting the bottom line. But this all feels like an economy that is maybe slowing down a little bit more than we'd first feared. And maybe this is the kind of the sort of the bad news is good news scenario where the economy slowed down, the Fed has to cut, and that, well, I'm still trying to figure out whether or not that's good for risk assets.
Yeah, I think this is what sets up 2024 to be a tougher year, and in part because we don't really know how fast the economy is going to slow. We are seeing cracks in the consumer, but the consumer is still employed. And as far as the retailers go, they benefited from a massive amount of inflation over the last 2 years. 25% inflation over the last 2 years. Units are actually down. So the consumer is buying fewer units. Big ticket items are down. There's pockets, whether it's restaurants or beauty or food, that are holding up better. But these are effectively essentials. Travel is starting to show cracks. So the U.S. consumer is going to be under pressure. We have insurance going up. We have food prices still high. We have, travel prices are still high. Oil has been coming up, and so gas prices have been going higher. So lots of headwinds for that consumer, especially as we go into 2024.
Or at least volatility for oil, down 4% today. It's very odd, the big move we've seen. Okay, so needle in a haystack. So what do you do? From a bottoms-up analysis, how do you sort of manage the uncertainty and the switch in narratives?
And so if we look over the last decade, as bond yields have come down, almost all boats have risen. And whether it's small cap unprofitable companies or large cap companies that are truly, forging new markets, everyone has benefited from an environment of low interest rates. And so the correlations have been high in our markets. We've talked about, how high correlations have been for a decade. I think that starts to come apart because each business is going to be really, and each stock is going to reflect the fundamentals of the business and the end markets and the way the business is run. So that's why we call it, like, we're really looking for a needle in the haystack for next year, which makes us really excited as stock pickers and as active managers, because it's companies that have been dislocated because of the macro that are still going to grow. And they're still going to be able to pay down their debt, or they're still going to be able to forge their way over the next year or two.
Anko, maybe 24 is the year of active. We'll wait and see. Somebody told me it was 23, but maybe it's 24. Uncle Crawford, Executive Vice President and Portfolio Manager, joining us from Alger. Still ahead, Cisco tumbling the most in 18 months. This after its revenue forecast raised concerns the companies are cutting back on tech spending. Details in the startup next. Ed's going to be here. This is Bloomberg.
It is 22 past 7 on the West Coast. Let's get to the startup, where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. It's a beautiful day. You feel really psyched to talk about this topic. However, Cisco shares are getting hurt real bad. The worst we've seen since in 18 months. Do you think this is an overreaction of the quarter and outlook that we saw?
It's the question, right? That what is it that the market's worried about? And what I would say is that when we're talking about networking equipment, we're basically talking about all of the physical stuff that goes in an office that supports the internet, right? And if this was a case that small and medium-sized businesses were holding off spending then it would be the macroeconomic story that Chuck Robbins warned us it is not. But usually what happens when we're talking about big corporates, enterprise customers, they do buy networking equipment in bulk when they're kind of building out a big office refurb or something like that, or they're moving premises.
Yep.
And so that was what they told us, right? This isn't macro. This is that they've already got all the networking equipment they need for this year.
Is this, I was wondering, I was trying to think about this, and I was wondering whether this is a work from home story as well. Like, is there some element to that people aren't going into offices, people don't need the equipment in the office in the same way that they once did, and it doesn't need to be kind of as big and as good as it once was as well?
I want to give full credit to Bloomberg intelligence analyst Woo Jin Ho, who I was talking about Cisco with this morning. And think of it like this. Some of us coming out of the pandemic had a surplus of toilet paper and hand sanitizer. And so therefore, we've not needed to buy any more of that in the last 6 months. It was remaining from the pandemic. And with networking equipment and all of the internet infrastructure that was needed to support that work from home process and hybrid working 2020 through the beginning of 2022, that spend's been done. That coupled with the fact that Cisco was one of many that faced supply chain challenges. So they had a backlog of orders. They filled those over the last 6 months to a year. Their customers took hold of that network equipment. Now they're installing it and utilizing it and holding off the spend. That's the story that Cisco's telling. If it's true or not will come out. There are sell-siders out this morning with notes saying, actually, we could be in a down cycle for networking gear. And that's the economic story.
But this is what's interesting is that Chuck Robbins was very clear, this is not a macro story, this is not a macro story. So I wonder, like, how long does that sort of inventory destocking, for lack of a better word, take until it becomes a macro story?
Well, I don't have a good answer to that other than this was an earnings report for the fiscal first quarter. And, you know, compare that with what we heard about the smartphone market from the semiconductor companies, right? They kept telling us that the market had bottomed, and yet here we are at the end of the year, and we're not entirely sure if it's bottomed. So, you know, the forecasts of CEOs and the behavior of enterprise customers, it's a hard one to read because historically they've behaved a certain way, but the pandemic threw that behavior into doubt. So we'll know in 3 quarters' time whether he's right.
Yep. It's fascinating, though, isn't it? The kind of the restructuring of the office story, the big enterprise story, and how the pandemic has affected that. We still don't know. We're still figuring that out. We still haven't got a clear picture. I think it's amazing that you're still seeing the effects on a share like Cisco to such a degree, and it's still the ripple effects coming out of the pandemic. Ed, great stuff, as ever. Thank you very much indeed. Ed's going to have more on this story a little bit later. Ed Caroline on Bloomberg Technology, that show coming up in around 90 minutes' time. Coming up on this show, a tale of two retailers. Macy's rises, Walmart slumps. After the earnings reports, Oliver Chen, TD Cowen, Senior Analyst for Equity Research, joining us next. This is Bloomberg.
We're about an hour into a U.S. trading session. Things are definitely moving. You're seeing some heaviness in the equity market. You're seeing a strong bid into the bond market. Oil's kind of rolling over. Home builder index was lower, so sentiment's not that great. So all of this kind of coming together right now in the session. Abigail's tracking the moves for us. Abigail?
And there's some choppiness with it for the S&P 500 and the other indexes, Alex. Take a look at the S&P 500 E-mini futures. Not big moves. You can see, in fact, a fractional move and fluctuating between small gains and losses. But investors trying to decide after some of the big gains this week, whether or not the S&P 500 should in fact stay above 4,500, well above there right now. But when you see this kind of whipsawed action, it again points to uncertainty in terms of the bulls and the bears really duking it out, for lack of a better way to put it. Relative to some of the other indexes, some volatility there too, but mainly to the downside. The equal weighted index down about 0.2%. So the S&P 500 right now being helped out by the weighting to some degree to some of those bigger tech names. But you can see China Tech down about 3%. That is because of Alibaba down about 8 or 9% after they nixed the spin out of their cloud unit. The Goldman Sachs non-profitable tech also down 2.9%. So some of the quote-unquote dash for trash that we've seen this week, investors are reconsidering today. And then the Russell 2000 consolidating some of the big gains this week, right now down 1.2%. Now, when we put this together technically for the S&P 500, it's interesting because we do, of course, have another range. It's all about the ranges and the uncertainty this year. Here is the range that the S&P 500 has clearly broken out from. But what I would like to point out, we've pointed this out before, it's on gaps higher. That really signals emotion. It's not informed investing quite often. And you can also see the quick move above all three moving averages, not great. The other thing to note, and this is more subtle, is the composition of this range. It's broadening, which tells you that there's bigger swings to the upside and the downside, that neither side really has great information. Those tend to be bearish. So I wouldn't be surprised to see the S&P 500 at a minimum cross back below into the range at least, and then maybe even toward the bottom. But let's work on the top of the range first. Or who knows, maybe it goes the other way. But again, this looks somewhat bearish. And then finally, in terms of retail this week, we have massive moves. And it's interesting because all kinds of different color on what's going on out there. Macy's up 22.4%. They put up a surprise profit on leaner inventories. We have Target also up about the same amount. And they, of course, put up a 42% profit beat. And they also had inventories drop 14%. Target, at least, a little bit cautious on the consumer. It's interesting because Walmart had that commentary this morning, Guy, and here we have TJ Maxx down, TJX companies, I should say, down 2.6%, and there was a little bit of a disappointment there in terms of the fourth quarter. But Walmart talking about this weaker consumer, at least at the end of October, that they're a little bit cautious. Target had similar commentary yesterday, but because Target going into that quarter was down 25%, shares rewarded. Walmart outperforming the S&P 500 going into their print up about 20%, and investors taking some chips off the table.
It's amazing. You look at these moves, they're in some ways hard to kind of rationalize given what's being said. And actually, the divergence in what is being said, maybe not that great, but the market reaction is great. Abigail, thank you very much indeed. Let's get more on what we are seeing here. Oliver Chen, TD Cowen, Senior Analyst for Equity Research, joins us now. He's got an outperform rating on Macy's. Price target there of 20. Outperform rating on Walmart. Target there, 185. Oliver, great to see you. Perfect person to talk to. Can you explain the market reaction to me? Is this about quarterly numbers and what these retailers are saying, or is it about how investors are positioned going into these quarterly numbers?
Yeah, Guy, you're right. In terms of how investors are positioned has been a key factor in sending some of these stocks higher. Ironically, the negative comping, negative sales growth retailers, the stocks have gone up, and the big story here is better than feared. The PE multiple is quite important to notice. At Walmart, we're at 22 times, whereas at Target, we're at 14 times, and Macy's is a 5 times PE. So valuations expectations were fairly low at Target and Macy's, and they beat by a little bit and raised, which is better than feared. The consumer continues to be under pressure, highly volatile. The big theme here is consumers are putting dollars into inflationary products that they need, like food and essentials and energy.
So, Oliver, before we just focus on Walmart for a sec on that, what is the right multiple to put on Walmart? Because if consumers are stretched, Walmart's supposed to do well. If consumers can spend more, Walmart could do well, that people are buying more in their stores, and people do still have jobs. So what is the right multiple for Walmart?
Yeah, Alex, we have an outperform rating in Walmart, and our target price is higher on a multiple that's in the mid-20s. I would say that as we think about Walmart, it does great in a defensive, everyday low price environment, but Walmart's also very offensive, particularly on Amazon. Think about Walmart Plus, think about digital advertising, the marketplace model, and also a leverage of artificial intelligence for both inventory management and conversational commerce. Specifically, we were just on with the management team and the AI team. They're using AI to help you with search and also provide you adjacencies when you look for something. So think about Walmart as a defense play, a global play, a free cash flow dividend yield play, but also a technology company with lots of data and empowerment and robotics and AI and curbside pickup.
Should Walmart be in the same group as the Magnificent Seven? You just described kind of Amazon. You just described some of these technology companies, their defensive characteristics. Is that how I should be thinking about Walmart right now?
Well, that is the path ahead, and it's the big opportunity because Walmart and traditional retail hasn't really gotten its fair share of digital advertising. In addition, marketplace models were pioneered by Asian internet companies as well as Amazon. Retailers like Target, Walmart, and Macy's can leverage the traffic and awareness they have in the mobile apps to sell you other stuff and establish third-party marketplaces. Walmart will continue to add product on their marketplace, and they'll be very curated and trusted. And you can also get gas at Walmart with Walmart Plus. So the future is phygital, bricks plus clicks, and really thinking about how to leverage all this technology. And frequency matters for AI.
Okay, let's go to Macy's then for a sec. So it definitely feels like it's the same, like the Target situation, where they finally figured out their inventory thing. So then they can kind of clear it out. They're in a better place. And then they can kind of grow from there. But where's the growth? Because clearly, if I'm strapped for cash, I'm not going to Bloomies.
Yeah, we are strapped for cash. Well, ironically, there's some bifurcation where some luxury is doing quite well. But you're right. What needs to happen across all is more unit sales. We need better traffic. And conversion rates, meaning when you walk in the store, you convert to buy, that's a big positive. Macy's has done a good job with controlling the controllables, meaning inventory management, getting the right stuff to the right place at the right time. But Alex, they need better product. They need product that appeals to younger Gen Z. They're working on private labels. What's big for Black Friday will be gifts, will be beauty, will be essentials. And fortunately, Macy's shines there. It's a bit of shrink to grow in terms of rethinking the store base, which is well in progress, and also small format stores. But again, trends are still negative. They did a -7. Street was looking for -7.2. So a little better than feared.
How long does the better inventory management protect them from the top line slowdown? At the moment, they're being rewarded for the fact they've got inventory under control, but the top line's still slowing, which protects the bottom line. How long does that last?
Yeah, you really need to try to have your cake and eat it too in terms of maintaining tight inventories. What's really next in retail is test, read, and react, and buying less and then buying closer to need. But what we should see is a couple more quarters at least of managing inventories tightly, and this should really be an ongoing effort. I teach a class on magic and logic at Columbia Business School. It's all about getting the right stuff to the right place at the right time. Really, next year, we're looking for positive comps. We need to see that growth, and we're hopeful that they can get both growth and margin management.
Hey, before I let you go, the majority of the team here is women, and we keep getting on Guy for not investing in his face. He's of a certain age. He's on TV. He does nothing for his skin except eat sardines. Is he alone in this? Like, or is makeup beauty care? Like, does he need to actually like invest in his face?
Well, Guy has great style, but everybody should invest in their face. Self-care is very important, and the sardines sound like a great tip. I take different forms of sardines, but investing in your face is a big deal. Cosmetics, skincare, wellness, that's what we see ahead. Our top ideas do include Walmart, Ulta, and Louis Vuitton and Costco. As we think about Ulta, that is like Home Depot for women, and rethinking what's happening there, social media, it will keep on growing as we see so much innovation across that.
All right, Oliver, thanks a lot.
Can I just make it clear that I'm eating the sardines, not putting them on my face? I want everybody to be clear on that.
Of course.
I think there are a lot of antioxidants and special things.
Oh, was that weird? No, that would be something. We definitely have a picture of that. No, he eats them every day. We talk about it, hence, like, it gives him all the good oil in his skin. He does not put them on his face.
Yeah, glowing, youthful, many properties there.
Yeah, exactly.
I mean, let's not go that far. Okay, they're telling us to, like, go. All right, Oliver, thanks a lot. Oliver Chen of TD Cowen, thanks a lot. This is Bloomberg.
Happy holidays.
This is Bloomberg Markets. You're looking at live pictures of the principal room. Coming up, Steven Center, Kia Motors America Executive VP and COO, joins Bloomberg TV at 1:15 New York time. This is Bloomberg.
As you know, I just concluded several hours of meetings with President Xi, and I believe they were some of the most constructive and productive discussions we've had. I've been meeting with President Xi since both of us were vice president over 10 years ago. Our meetings have always been candid and straightforward. We haven't always agreed, but they've been straightforward. and today build on the groundwork we laid over the past several months of high-level diplomacy between our teams. We've made some important progress, I believe.
That was U.S. President Biden after meeting with Xi Jinping at the APEC summit. And then just hours later, President Xi addressed an entire room of CEOs and executives about China's economy. Maybe, kind of, sort of. So that brings us to the question of the day. Is China actually more investable after the summit, as an investor, as a foreign investor, as a CEO? Joining us to discuss is Amy Selico, Albright Stonebridge partner. Prior to joining the firm, Ms. Selico served as Senior Director for China Affairs at the Office of the U.S. Trade Representative, and she was in the room last night during President Xi's speech. Hey, Amy, what was your takeaway? Like, if I'm a CEO and I'm an investor, do I feel better today?
I think everybody feels better today after not just the dinner last night, Alex, but of course the day yesterday, where both President Biden and President Xi coming out of their closed door talks, and then publicly President Xi speaking to an audience last night, President Biden in his press conference saying, we made progress on areas to continue talking about managing this relationship. So on that front, of course, everybody in the room was reassured that President Xi came to that dinner after a tough day of talks and gave a very personal, warm address to the room. However, he didn't really address the CEOs in the room, specifically mentioning anything about the Chinese economy today or reassuring them that American investors remain welcome in China. He spoke more obliquely about that, about the path forward being cooperation. But I was a little bit disappointed we didn't hear him speak more directly to these supporters of his in the room, the way, I might add, that Secretary Raimondo did in speaking prior to President Xi, in saying this economic relationship is very important. We want it to be a ballast in the overall relationship. But of course, there are going to be areas where we're going to have to protect American interests.
Amy, good morning. It's Guy. She would, I'm assuming, have done that deliberately. Our understanding going into this summit was that from an economic point of view, he was coming to elicit more trade. He was coming to elicit more investment. If that was the case, why didn't he do as you suggested? What was the aim, therefore, of the speech that he did give?
Well, I think the aim of the speech was to reassure stakeholders, not just in the room, but of course back in China, in the global south. I mean, we heard from the Vietnamese leader earlier yesterday here in San Francisco that everybody is going to be listening to what Xi Jinping says about U.S.-China relations, because stability in the relationship is such an issue, not just for the business community, but certainly for all of the 300 and some people who are in that room. And so President Xi did directly address that. And he posed the question of, you know, are we going to be partners or are we going to be adversaries? That's the choice here. And he laid out how we can be partners. I think many of us in the room think that the relationship is more complicated than that. It is defined by competition. Managing that competition effectively is what matters. And certainly that's what President Biden and President Xi spent a lot of time talking about, managing the way forward.
Okay, so if I'm the FedEx CEO, if I'm Tim Cook, if I'm the Boeing CEO, what am I thinking today that I wasn't thinking yesterday? Do I have any clarity on what kind of investment plans I can make within the country?
Well, a negative U.S.-China relationship really has been weighing down so many companies as they're looking at their China strategy. Are they going to face overt discrimination because they're American investors, or are there going to be issues that are going to impede their ability to continue to grow? So President Xi very openly and directly saying a constructive, good U.S.-China relationship is good for China's interests, is important. But today, the day after that speech, the day after the bilat, CEOs are going to roll up their sleeves and say, okay, what about those approvals for new airplanes? What about those global M&A deals? What about my plans to invest in the market? Am I still as welcome as I was? Secretary Raimondo. Her counterpart was among the delegation, Wang Wentao. Certainly, they're going to continue talking this week about those very specific issues in the commercial relationship. And I think CEOs are going to push to see some real progress and not just a little bit more esoteric, but positive commentary.
Amy, do you think over the next few days that, unless there are some positives, I was with Stan Deal in Dubai on Monday at the Dubai Air Show. He was hot-footing it back, the Boeing head of commercial, to go to this dinner. And there was an expectation that we would see some deliverables come out of that. I haven't seen any yet. And I'm wondering if over the next few days we don't see those deliverables, whether the perception of this meeting changes significantly.
Well, I think that's what all of us are waiting for. And I think on the Chinese side, they were waiting to see, was there a positive environment coming out of that meeting, yesterday's meetings, that would justify real progress on commercial issues. Certainly, that's what CEOs are hoping, that yesterday has laid the groundwork for exactly what you said, Guy. Now let's get down to some of the real commercial issues that we need to talk about, that we need to see progress on. That environment certainly has been set. I mean, the U.S. and China, both President Biden and President Xi, did talk about restarting lines of communication on the commercial relationship. While they didn't address that directly, they did discuss enhancing people-to-people exchange, making it easier for visas to be processed, more flights between the two countries, coordination on tourism. That does mean there are commercial interests there. We didn't hear about them directly, but you're right. I think now is the time when the Chinese government may feel more comfortable making progress on that.
We'll see what the next few days bring. Amy, perfect person to talk to. Somebody in the room. Great for you to join us. Thank you so much. Amy Selico, Albright Stonebridge partner. This is Bloomberg.
All right, time now for Wall Street Beat. We take a look at what's buzzing on Wall Street in the world of banking and finance. And today we're going to take a look at layoffs in the hedge fund business, with Schoenfeld cutting about 15% of its staff. Joining us now is Bloomberg's Shonali Basak, and this comes after Schoenfeld and Millennium kind of part ways. It looks like Schoenfeld got an infusion from some of its clients, and then this is like the penalty for it. Am I reading that correctly?
We have to take one big step back here. And the reason is because Schoenfeld, and yes, this is the storyline as of late, but remember, Schoenfeld is kind of the poster child of the multi-strat world here, of growing very, very quickly, expanding into areas that were very hot in this market, like macro. And now you're seeing Schoenfeld, as well as many other multi-strats, start to see performance starting to wane. And then all of those people, there are questions about whether they're making returns as quickly as their investors would like, and as quickly as they can to keep costs in control here relative to what they're taking in. So Schoenfeld now, what are they cutting? It's about 15% of the staff. It was a great scoop by Bloomberg's Hema Parmar, which also said that 5 of those people were portfolio managers, but the rest of it was largely technology back office roles, because what has happened as these funds have brought in new staff, they largely pay the investing talent through pass-through fees. They pass these costs on to investors, and then that back office, technology, critical infrastructure to run the firm is what the cost base is for the firm. And so that's where you're seeing a lot of the pain in the hedge fund world. But again, the reason I drew it out so much is because if this is happening to Schoenfeld, then you really have to start asking questions about where else you're going to see this happen.
That was what I was wondering. There was a time when all of these people would walk out of the door and get new jobs instantly. Is that still going to be the case here?
It can't be, really. I mean, some of the people, too, and remember, even among the high performers, once you see this kind of trajectory in a firm, you can bet that the hedge fund industry, it is pretty Machiavellian here, Guy. You have all the funds looking around, seeing what's happening to each other, and trying to pick out the best talent and offering better deals elsewhere. So that competition for the best of the best is still happening while you are seeing a lot of pain still at critical roles. I will say one person in particular is very interesting in the set of of departures you're seeing at Schoenfeld. According to Hema Parmar's story here, this was mutually agreed upon, according to Ben Malkman, who had only joined in March.
Yeah.
He had shuttered Light Sky Macro, had planned to run his own firm, and came over to Schoenfeld to start, managing money there, and had left so quickly. It just shows you how quickly things can move in the hedge fund world, and just kind of how sour things are getting in the industry.
Sonali, great stuff. Thank you very much indeed. Sonali Basak joining us, talking us through the Hema's great story, what is happening, particularly at that kind of multi-strat end of the hedge fund community. Let's talk a little bit about what's happening in terms of the markets right now. European stocks are sliding a little bit, but only a little bit. We're only down by 0.6%. We've seen a really big rally, kind of 3 huge days. Today we see a little bit of a rollover, but it's not much. 451.9 is where we're trading right now. A few individual stocks, we're going to talk about those in the next hour. Stocks like Siemens on the move. You've got Burberry on the move. So some really interesting narratives developing. Yields are bonds generally bid. Yields are moving a little bit lower right now. There's the US data, I think, that is kind of worth bearing in mind. You've also got a big move in oil that's worth watching and paying attention to as well. We talked about what's happening in China. If China had seen last night's meeting as a positive one for Chinese investment, maybe you wouldn't have seen this today. The CSI 300 down by 1%. The pressure continues. Virginie Mezenevra joining us from Allianz next. We're going to discuss all of this. This is Bloomberg.